Hi, everyone. I'm Rick Bensignor. Today is Tuesday, February 8th, and welcome to this week's In the Know Trader show. On tap for the week, in the half hour that we spent together, in trader education, we're going to talk about commodity spreads. And for those who are traders of futures markets, what we're going to talk about, it's a short conversation, but is very important to understand. So we're going to get into the differential of pricing in between different contract months in the futures markets and the implications of that. In our market overview, we'll take a look. Actually, DJI, we're not going to look at the Dow. We're going to look at the QQQ. My mistake for having that there. So we're going to look at the QQQ this week, the US 10-year, and then we'll look at consumer staples, and we'll go through a dozen or so of the top performing, not top performing, but biggest weighted names in the XLP. Because if you're playing staples, these are most likely the ones you're going to find yourself in. To sign up for my weekly tactical trader report that always gives a new ETF trading idea each week, as well as goes through the macro picture of the market, looking at bonds and credit spreads and usually gold, the dollar, and a deep dive into the S&P. Sign up for the tactical trader report at intheknowtrader.com. And also we have our monthly 7-Eleven report. The goal of that is to beat the return of the spiders over the medium and longer term. We are doing that nicely, both on a short-term basis. Our fiscal year, we're ahead of the S&P. And since we started in August of 2020, we're outperforming by, I think it is 4.3 or 4.4% in 18 months. So that is a huge outperformance in running a portfolio that is meant to be in the S&P space. Especially just playing the macro spider ETFs. And again, to get that, intheknowtrader.com is the place to go, and click on the sign up tab, and you can do that. Let's take a look at how the markets are doing since the beginning of the year. So here are the macro sectors. Year to date, look at energy, just an astounding outperformer that is up 30% more than the S&P is. The S&P itself's down 5.8%. That's the spiders, which of course track the S&P 500. Worst performing sector. We've got a few very close to each other. Consumer discretionary, that's XLY. Communication services, XLC. And real estate, XLRE, all down almost 10%. Technologies not having much of a good go either, underperforming, down 8.8%, with materials at 8.7 on the downside. So look, you've only got two outperformers this year, financials and energy. And otherwise, you're basically losing money. But if you're not losing as much as the S&P is, then you're still outperforming. Don't forget that in a down year for the market, if you lose less than the market, you have outperformed, even though, yes, of course, you've lost money relative to the prior December 31st. Okay, let's take a look at and talk a little bit about commodity spreads. So even if you don't trade futures, if you are trading commodity ETFs like USO, which tracks the oil market, UNG, which tracks the natural gas market, and there are other ones that track specific commodities like PPLT does platinum, and there's these days there's coffee and corn and wheat. Lots of ETFs now, lots of commodities now have ETFs that track them. GLD for gold and SLV for silver, etc. If you're trading commodity-oriented ETFs, you want to understand what the commodity futures markets are telling you. And in understanding this, there's two important things to know. Generally, commodity futures markets are priced what's called a carrying charge market, or in the vernacular of people in the industry, it's called contango. It means that each contract month in the futures market is priced higher the farther out you go in the future, such that December gold for this year is almost always priced higher than April gold of this year. And that's because there's carrying costs and transportation costs and storage costs and other things built into actually holding the commodity longer over time. Therefore, there's more value or cost to doing that, making the December contract higher than the closer month contracts. Occasionally, you get into a situation where there's so much demand for a product that the near-term months are actually priced higher than the farther out months. And that's called backwardation. And if we take a look at something like oil right now, front month oil, March oil is trading down at, it's down $2.50 today at 88.80, but April, the next contract out is at 87.40 and May is at 86.06. So in other words, oil for the first few months are backward. There's enough demand versus supply issues and storage issues such that the front month is trading higher. And looking at the differential between how these months trade is often a good clue of what's going to come next. So as we switch to our charts, let me bring up the price of oil. So here is the front month price of oil going back over a year. And obviously, oil is in a long-term bull market. We've seen some pullbacks that, in percentage terms, are very decent pullbacks at the time. So you can see in November, we pulled back from about $85 down to 62.5. So again, percentage-wise, very large move, but basically long-term uptrend. So that's just a standard bar chart. Now I want to put on Tom DeMark's sequential model. And I want you to see where some of these 13s show up for potential exhaustion of trend. Here's one in March of 2021, pulls back, takes a couple months to exceed that price. Late June, we've got a signal here, goes slightly higher, but pulls back, and that you're not stopped out from that signal. So, you've got, again, a material decline. Late October, upside exhaustion signal, huge decline. And then what do we see 2 days ago? Upside exhaustion signal. So I'm thinking to myself, do I stick my neck out and sell some oil? And I thought, what else can I look at besides this model to potentially give me a sense of what's going on? So then what I did yesterday is I looked at the spread differential between March, the front month oil contract, and April, the second month. And this is that spread over time. And just like in November, when oil sold off, the spread between how much the front month contract was above the the secondary contract came way in. In other words, the spread came in as oil sold off. And I look at this and I see that this has had a huge up move recently. And then yesterday, this spread dropped. I'm going to blow this up. So today's Tuesday, last Friday, it had closed at $1.96. And I see yesterday that the spread is collapsing down to $1.55. So it pretty much dropped 40 cents in a single day. That's a dramatic shift in what has generally been looked at as a very bullish market in oil. All of a sudden, the amount that March oil was trading above April oil came way in. That's often how the smartest people in the markets make their plays, is watching spreads and playing the spreads. They don't necessarily speculate on the direction of the market. They speculate on the differential between certain contract months. And what this did was help confirm for me that that daily 13 that I saw in oil, that the people, the insiders are the people who understand this. And if they're selling the spread, then that 13 is probably a good 13 to lean against. So I put the spread on and I shorted the front month and bought the second month, because as oil goes down, they're going to hit the front month harder. So the differential comes in. And that's what we're playing now. And you're seeing this tick. I've blown this way up. You're seeing this tick in real time that, in fact, again, that spread is narrowing. So that says to me that oil probably has another temporary top, and it's had a dramatic move up since that November bottom, right? So if we go back to the oil chart, we see, since December 1st, this thing has been flying. And again, we get kind of this indication that price may come in. So oil's down $2.50 today, and it's a good trade so far. And, you can play this outright and just try to, fight the price of oil, which generally hasn't worked well. Or you can play the spread coming in, which is what I did, which is kind of a safer way because I'm exposed to the price of oil. But because I'm long one month and short another, all that really matters is the difference between the price movement of those two. I'm not necessarily picking which way I think oil is going. In this case, because I played a bearish spread, I do think oil's coming in a bit, and I can play it that way. But I wanted to bring this up just because if you're playing any of these commodity ETFs, you want to look at the difference in price between usually the first 1, 2, or 3 contracts that are in the whatever cycle they're on. And you can often get clues of what's going on in the market and what's about to go on in the market. When you look at what the spreads are going to do, it puts you in a better position to make a smarter guess about what's going to happen in the underlying commodity than simply just trying to look at the commodity itself and use technicals on that alone. So that's today's trader education portion. Let's take a look at what's going on in the macro markets themselves. So I mentioned we're going to look at the Qs. So let's take a look at the weekly Q chart. And I've got this running with a couple of other models. The cloud chart is on here. This is a 50-week moving average here in red. So a couple of things of note. Look at where these sequential 13s came in the past. Looks like last August, we've got an upside exhaustion signal here. We sell off for the next 3 weeks and kind of stay in that range or beneath it for another month or so before eventually this moves higher. We get another signal in April, upside exhaustion. We pull back for the next 3 or 4 weeks before this resumes and starts going higher again. And then recently, essentially kind of testing all-time highs, boom, we get another exhaustion signal. And that's been very good and the best of them all, in the sense that we've had the most dramatic decline. But also in doing that, we noticed what's changed on the cloud chart. Well, back in early part of 21, the decline stopped at the cloud model's baseline. That's the arithmetic average of the most trailing 26 weeks. So it looks back 26 weeks, finds the highest high, the lowest low, adds them up and divides by 2 and plots that value. Right, so it's kind of like a moving average, except it's not a moving average of closes, it's a moving average of midpoints. And again, in this case, it's 26 bars. Once a new week opens, or if you're looking at a daily chart, a new day opens, it's that bar that represents the current bar, and then look back at another 25. So it's the current plus 25, giving you a total of 26 bars. And again, it finds the arithmetic average and plots it. So we had lows in early 2021 against the baseline, which is support level. In May, where's the low? The baseline. In October, where's the low? The baseline. In December, where was this pullback? The baseline. If then test the high, fails, and what happens? We end up, this one's tough because we close right on it, but then the next week, so we're into January now, boom, we clearly have broken this. And that says to me, we're probably going down to next targets. In the cloud model, that ends up being the cloud itself, this shaded zone. And sure enough, basically the top of the cloud is what bottomed this sell-off. Now, precisely, it went to the propulsion full exhaustion level right down in here, which is a measurement that got instituted on the break of this 372 level. It said that it would measure down to 336 and change, and certainly the low of the move is 334 and change, right? On the comeback in the market, where did we stop? Well, we stopped pretty much exactly on the conversion line, and it was just a hair above there, and the baseline is right near. So the conversion line, this magenta colored line, is the arithmetic midpoint of the last 9 bars. So between that and the arithmetic midpoint of the 26 bars, which of course included the all-time high versus the low we saw in January, you've got your resistance area, and that's exactly where we've topped. Since then, we've pulled down to these 2 lines, which were there again before we got there, which are bearish propulsion levels if properly exceeded. So right now we're caught in a pretty darn tight range. In fact, if I flip this to a daily chart, you're going to see that we are caught between the daily conversion line, which is this pink line. This is now 4 days in a row. The low has been from the cloud model. The high a week ago was the conversion line, the baseline on the daily cloud chart, which would have been the same as the weekly conversion line in this case. So these are very helpful tools on where you can expect markets to find potential support or resistance. So 4 days in a row, this is holding. You know, if we get beneath here, that's not good at this point. As long as this keeps holding, wouldn't surprise me if we come back up and test there. The longer we hold the conversion line, the more likely we're going back to the baseline. So that's kind of a look at the Qs. Let's take a look at the US 10-year, because it is up on now the best levels that it has seen in a couple of years. There is, of course, the significant, and let me just take this bar away, this pointer. So follow my cursor or my pointer here. Rounded shoulder, that's the inverted left shoulder. This whole down move to all-time lows is the inverted head, and then a shoulder on the right-hand side. In fact, a second shoulder that has broken out above. Here's our neckline in green. And we've also broken out above 1.86, the TDST level that I've been concentrating on as the real breakout point. So we are through that. And this suggests to me that later in this year, we'll likely get to probably 2.25 up to as much as 2.5%, the next measured target up, all off of the bottom here and the thrust that we expect off of last July's low. It's all these measurements here to the move to 181 and then 250 are all based upon this move here and how it relates to the prior move. So I do think rates are going higher. Notice you're essentially still somewhat darn close to, what was the highest tick back in October of 2019. But I kind of get the sense that things are likely going to go. Right now, bonds are somewhat overbought, but I'm not expecting a major pullback given what this structure looks like. And of course, a more hawkish Fed. Lastly, let's take a look at, let me just take one of these away here. Let's look at the weekly XLP chart. So this is consumer staples. Here's your 200-week moving average. Here are a couple of sequential signals that gave you some interim pullbacks. But notice we're not far from all-time highs here. This is still holding structurally decently, and as an outright chart, this is not a bad chart at all. Staples actually have a better looking chart than many other of the sectors now, and of course, because they've been holding up nicely during this whole interim that we've had since essentially Thanksgiving, when Omicron became known in the US. It was Thanksgiving Day, literally, that the headlines kind of came about this new variant to COVID, and since then you've seen a nice up move. So here's kind of your Thanksgiving time frame and what this has done since. So this looks a lot better than a bunch of other charts, which made me think about, well, let's take a look at some of the top names here so we can get a sense if anything's really worth buying or where are the support levels to work with. So let's start off with Procter & Gamble. Had a sequential exhaustion signal on its highs. We've gone sideways since, but notice that here, where's the recent sell-offs to? Well, back in October, we got down to the baseline from the cloud model, but since then, pink line low, last couple of weeks, pink line low. We're virtually on it right now. So there's, in theory, some support here. If that doesn't hold, then we get down to the 151, 148 level. So if you like this and you still think the market's going higher, then right in here is theoretically some support. If this can't progress and make new highs, then we're going to fall and get some type of pullback minimally to this level. So that's Procter & Gamble. Let's look at Costco, second heaviest weight in this group. You can see too, exhaustion signals on the high. Now, this is a weaker chart than Procter & Gamble because the pullback did not hold the first level of support. It didn't even hold the second level of support in January. In fact, since then, the conversion line has been where we've stalled, and we're sitting on it right now. So this is kind of interesting whether or not something that climbed up this magenta colored line in the past is going to find resistance here, or whether or not, I'd say anywhere from current price up to, which is almost 522, up to about 535 is going to be resistance here. And only if you thrust through 535 can you then approach and test these highs, if not exceed them. Otherwise, if we stall in here, look for a potential retest of that January low. Pepsi. This one made new all-time highs just 2 weeks ago. So this is even stronger than anything else we've looked at and is holding against this pink line, right? The or magenta colored line the last couple of weeks. So this is actually stronger. Notice back in September, the lows were against the baseline. So this is actually the best name we've looked at so far. If you're thinking of, so for instance, what's a natural pair trade? Long, let's say Pepsi and short Coca-Cola. Let's see if that works. Well, here's the Coca-Cola chart. It's actually stronger than Pepsi. We're currently on all-time highs. So if you were going to put those on, you'd probably buy Coke and sell Pepsi. They're going to work very much similarly. So this is not a trade that you would like get mushed on unless one earnings did really well and one earnings did really badly. And I'm not talking about the fundamentals here now when I talk about this in the sense of I'm just looking at the charts. You have to do your work on the fundamentals too. But Pepsi's Coke's on all-time highs. That's darn good and makes this kind of the strongest name we're looking at in the space. Philip Morris, a little bit beneath all-time highs, which were made on 13s back in late summer or midsummer last summer. We sold down to a 9 into the cloud. We've now made a 9, kind of transitional point. You would have to get above all these levels here, which is like 109 to 111-ish before I'd really want to go buy this now. So this is also ripe for a potential pullback. I wouldn't expect it to be strong, but maybe it pulls back $10, which is 10% down to, I'm sorry, it's not $10. We're at 104-ish now. So it's only a few percent down to the cloud again. You know, it's kind of a tough name to define what to do right now. MONDELEZ, close to its all-time highs, recent lows, against pink, but you could see sell-off, this is not as clear, even though it held the cloud and it's come back and it's nice. The other ones in many ways kind of look prettier. But there's still a solid name and one of the better names to look at in the space if you're interested. Walmart, not as good a name. Look, I'm going to draw a straight line. So here's all-time highs. We got close to them again in August. We got close to them again in November. We've pulled back. Prices just tucking beneath the cloud. The lagging line still in here. This is pure sideways. If I looked at this on a daily chart, your 50-day is probably completely flat. No bias right here now, other than, yeah, longer term, you're still higher. But there's clearly major distribution going on in Walmart up here. Nothing is broken of significance, but obviously since I don't know, it's a year ago in October when it made its highs, so October of 2020, this has gone nowhere. Better names in the group to be in. Altria, MO, definitely a weaker name. So well off highs, has some upside exhaustion signals over. You can see where highs are way above this going back 3-4 years. Downward sloping 200-week moving average. Not clearly not one of the names that one need to be in relative to other ones. Estee Lauder made new all-time highs right at the start of the year, straight down to the cloud. It's at least holding kind of top of the cloud, but again, better names than this. Take a look at your MACD, how weak that is. Other names have, in the space are better to be in. Colgate-Palmolive, very choppy, has gone nowhere since third to fourth quarter of 2020. It is above its 200-week moving average. That's got only a slight positive incline. Again, up, down, just sideways. Nothing of particular note here way to be in it relative to some of the better names we picked. Kimberly-Clark, same type thing, just bounced on the 200-week, just like it did back in October, but with a 9 high, nothing particularly good there. And the last one we're going to take a look at today is Constellation Brands. Made new all-time highs to start January, along with the 13s pulled back. Again, you've got a trading range here, something like this, but other names we looked at are better ones. And that's the show for this week. Hope you liked it. This is Rick Bensignor, and this has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.